Hello and welcome into the Retirement Playbook, brought to you by Alspaugh Wealth Management. We're here with you every week, bringing you some great information for you and your family to get to and through retirement. And as always, I'm joined by my co-host, Mr. Tony Shore. Hello, Tony.
Hello, Brock Alspaugh. Great to be here, buddy. I'm excited about the show today.
Me too.
And I got to meet a superstar before the show, Gavin. Said hi to Gavin. You've got the apple doesn't fall very far from the tree there. Great kid. You got going on there. Great guy.
He's a good kid. He's a good kid.
Yeah.
When he wants to be,
Yeah.
That's every kid, though, nowadays.
Yes.
Right?
Yes. So you've got a great show lined up for us. But first, I know you've been busy. You just got back from yet another financial conference.
We did.
I know you're an in-demand guy where some of the top advisors from the country got together and hung out. How did that go?
It was fantastic. And Tony, as always, it's one of those deals where the meetings are great, but where you get the most benefit out of these things is the collaboration. After
Talking
at dinner,
to other advisors who are
talking
doing
to
what
other
you're
advisors.
doing.
What are they doing? What are they seeing? What are they talking about? What are their clients talking about? So it's just a really fantastic way to get some new ideas and to talk about what we're doing and what works and what doesn't work sometimes, and then what other people are doing. It's a great time.
Yeah.
Plus a little R&R, right? A little relaxation.
A little R&R. That was
a little
good
recreation. So
it was in Colorado, so you got to have some fun while you were there, I imagine.
I haven't spent much time in Colorado.
Oh, I love it.
I've only been there one other time, and this was the Colorado Springs area. So it was a fantastic. We got there in the day. We got there was 70 degrees as a high. No, a little bit different than the 100 degrees with humidity here. But
yes.
Anyway, no, it was a great time. My wife and I went out there. So thanks for asking. Thanks for bringing that up. Yes, of course, we had a great time. So
good. Well, now we're talking about taxes.
Yes.
Once again on the show, but
sexy topic.
It is a great topic, an exciting topic. Please don't look away or tune away, listeners, because actually we have some important information that you need to be ready for, some planning tips, because according to the title you gave me for today's show, taxes are going to be on the rise more than likely, right?
Yeah, they are. So, Tony, one of the things that there's multiple things, but there are two specific things that if you're not considering within your retirement income plan, that would be number one, taxes, and number two, inflation. But when it comes to taxes, that's something you can control at some level. With inflation, that's out of your control. You can't do anything about it, right? And so let's talk about something you can control and try to minimize, okay? And that's taxes. And Tony, in 2017, President Trump signed the 2017 Jobs and Tax Cut Act, okay, which was awesome, great for people because they were saving money on taxes and have since then in 2017. But many of those tax breaks that he signed in with this law are going to expire at the end of 2025, okay? So we're going to talk about that here today on the show. We're going to talk about that and how you can help yourself and give you some tips and ideas to kind of pay. Look, we don't want tax avoidance, right? That's a whole nother subject. We're not doing that. But what we are going to talk about is minimizing what you legally have to pay to the IRS and to your state taxes, okay?
Minimize that tax burden.
Exactly. So let's kind of talk a little bit more about the 2017 Jobs and Tax Cut Act and how it might affect you. And we actually have some different tax rates that you'll see here. So, for example, the 33% tax bracket went to 32, so not a huge break there, but most people are going to be in that 15 to 28. Well, the 28 bracket was reduced down to 24, Tony. Okay, and when you're talking about 4%, look, that is the amount of percentage points. But if you look at the percent that it actually went down, so 4 divided by 28 is, that's somewhere around what, 20% reduction in taxes?
Yeah.
So that's a big deal. Okay?
It is a huge deal.
And so if you can save 20% on your taxes, you could do that. Well, President Trump did that by signing this 2017 act. So the 28 went to 24, the 25 went to 22, 15 to 12, and so on. So that is one flag to say, hey, advisor, you might want to talk to your clients about how this will affect them and what they can do about it. Okay. And one of the things that we've always talked about, and Tony, you know what I'm going to say. I love the what? The Roth IRA.
Yes, the Roth, a tax-free bucket of income to have
Exactly.
in retirement.
So then why wouldn't you say, okay, if we know that this is a temporary deal, right? In other words, if you're in the 20, your highest income is taxed at 28%, and it was 24 for the last, several years, but we know that it's going to go back to 28. Why wouldn't you do things now to help yourself later? And the Roth conversion is one of those strategies we've put into place. Now, we've slowed down on that a little bit because the market has been so high here. And typically what you would want to look at is doing a Roth conversion when the market is maybe a little bit lower, because then the growth on that money is tax-free, okay, if you take it out in retirement. So that is one of the strategies that you can look at. The other strategies is saying, hey, looking at your taxable income, and if we say you're saving this amount of money, okay, there's some investments out there that will give you deferrals, right? And so if you're saying, hey, I've deferred all of this money, why won't we take a little bit more of that deferred money now versus taking it in 2026 and beyond? Okay. The standard deduction too is another aspect of this, Tony. So not only have tax rates been lower lately, the standard deduction, for example, this year, standard deduction, $29,200 for married couples.
Wow.
That's awesome, right? It's
Yeah,
crazy,
that's
but
huge.
it's huge. So that's why I don't know what the actual number is, but that's why so many more people are not itemizing. They're taking the standard deduction.
Almost no one I know is itemizing
I mean, a
because
business owner for sure, probably, but outside of
oh,
that,
sure.
Tony,
Yeah.
I mean, again, I don't have the numbers, but I'm going to guess, and this is Brock Alspaugh guess here, that 95% of people are taking standard deduction versus itemizing all of their deductions, right? Because they just don't have enough deductions to get to that $29,200 level, okay? Now, I will say this. One of the things, if you do take the standard deduction and you're looking to say, hey, I want to save a little bit more, I want to get a little bit higher deduction, some people in the strategy we put into place, maybe you sell a lake home, maybe you've got an inheritance that you've gotten, whatever it may be, if it's causing some taxes for you, one of the strategies you could look at is what we call bunching your deductions. So let's say you give $10,000 to your church every year, but you still take the standard deduction, right? Because it's $29,200.
Sure.
Well, what if we bunched them together 5 years worth? That's $50,000, and deduct that in 1 year, okay? Because you had this special tax event. So 50,000 is obviously more than 29,200. So that in that particular year you would itemize, okay? So
I
yeah,
see.
bunching your your charitable contributions is definitely a strategy you could put into
I've
place.
never thought that's a great strategy. I had never thought of that. Instead of giving each year to the church or to a charity,
Right.
wait and do it 1 year and bunch them together so it's greater than the standard deduction.
Correct. And so what we sometimes use in that
Makes
case,
sense.
sometimes using that case, instead of saying, okay, well, we're going to give the church 50,000, they put it in a donor advised fund. And if you have cash that you put into that fund, it's the same thing. You get the full deduction of the 50,000 if you use cash instead of maybe some appreciated stock. So the point is that you put it in a donor advised fund, make a distribution of that same $10,000, but the rest of it's invested. So you're making money inside that donor advised fund. And by the way, there's flexibility with a donor advised fund. You can send it out to any 501c3, and it's real simple. We've done it for a ton of clients, and
Yeah.
it's a great
Whether
way.
it's a charity or a church, any nonprofit organization, I think
Exactly.
that's fantastic.
Yeah. So,
Yeah.
there are things that you can do. Now, if you're looking at that potential strategy, you might want to wait maybe a couple years because of these the standard deduction is probably going to go down. These tax rates are going to go up, so you'll get a little bit more benefit by doing this in the next couple of years. But you can't control if you get an inheritance and some taxable money comes to you. You can't control that.
No.
So do it anyway. I'm just saying, if you want to maximize that strategy, maybe look at doing that, in 2026 and beyond.
Yeah.
So definitely some great. I mean, we're only halfway through the show, Tony, and we're already dropping bombs, baby.
Yeah. Well, yeah. And that I'm glad when that bill passed, it increased that standard. It set up that standard deduction, which is way better than the personal exemption or itemizing. We used to itemize, and I thought we were doing pretty good when we itemized, but not, between my wife and I, not $29,200.
Yeah. I mean, it's like I said, I think 95, it may be higher than that, Tony. I don't know, percent of people, take that standard deduction.
Yeah. I've heard it's pretty high. The majority of people anyway do. Yeah.
Right. Also, Tony, pertaining to the 2017 Jobs and Tax Code Act, when the Affordable Care Act, remember that? President Obama signed that, right? And made healthcare more affordable, or I don't know if that's actually the right word to use when it comes to paying for healthcare, but that's what
seems
the
like
thing
it
was.
Goes up exponentially every year, no matter what. Yeah.
Right. But it included tax penalties for people who neglected to buy health insurance. Remember that?
Yep.
And the 2017 Jobs and Tax Code Act eliminated that requirement, right? The legislation also increased the child tax credit to $2,000 and created a $500 credit for non-child dependents. So
yeah, my wife and I enjoyed that child tax credit too, but unfortunately, all our kids are too old now. They're off the books.
Well,
so the last 2 years we weren't able to enjoy that.
I still got them, but trust me, I'm still negative on that deal. Right? They cost way more than what benefit I get.
Yeah. The tax credit would have to be hundreds of thousands of dollars at this point, right? I mean, you can't even buy your kid the new PlayStation for $2,000, or that doesn't pay for an hour of college. That's for sure.
Oh man, yeah, that's pretty crazy.
or that's a couple pair of sneakers these days. Right?
It is. It feels like it.
It does.
So, but by the way, Tony, both of those changes I just mentioned, the child tax credit going to $2,000 and not having to pay that penalty for not buying health insurance, will both vanish. Same deal at the end of 2025. So. That's something to consider, is that, hey, if my child tax credit isn't as high, that means I have less discretionary in that income, right? Because I don't get as high a deduction. So something to plan for is like, hey, I'm going to have to pay a little bit more in taxes. So make sure we budget that in. And that's not including the additional, tax rate dollars that you're going to have to pay. So it's going to be a double whammy unless they do something. And I don't know. I guess a lot of it depends on what happens here in November, but I mean, they expire for a reason. I don't know. They may be continued. Who knows? But we have to, and that's the thing, Tony, in the planning world, you have to plan for what you know, right? And so that's why we do annual reviews, because we update plans all the time based off of what? Market performance, interest rates, legislation, taxes, inflation. All of these things make your plan change from time to time. And so, again, we're going to plan for what we know, but, things change. One other thing, Tony, the estate tax is also an issue here, right? Okay. When you die, guess what? You may have to pay taxes, or your beneficiaries may have to pay taxes if your estate is too large. The legislation increased the estate tax exemption tax, and this year it is going to be 13.6 times 2, right? So that's 27 point, 8 million or 2 million. And so that's if you don't have an estate that's worth more than that, you don't have any estate taxes. Okay.
Wow. Yeah. Is that what you mean by the maximum of $13.61 million?
That's correct. So, and that's for each person. So if a married couple gets double that. So if your estate is worth less than 27 million, which I would say that most people fit into that bucket, right?
Yeah.
But that has gone way, way up. Okay. I remember, Tony, when I first got in this business, you know what that estate tax exemption was?
It was really low, right? Like 300,000 or something crazy.
$600,000.
Yeah, yeah. I knew it was below $1 million, which is nowadays is crazy. So if you inherited a family farm or a business or anything with a decent house on it or property,
Right.
you were stuck paying a lot of estate taxes.
Yeah. So, those are going to expire. I mean, I'm not saying it's going to go back to 600,000 in 2026, but at the end of 2025, these crazy high rates on estate tax exemptions have gone, they're gone, and we don't know what they're going to be.
Well,
I
let's
have,
admit, yeah. Well,
I
let's
have, I have heard, Tony, and I've talked to a lot of estate planning attorneys because we, work with them. I have heard that they expect that number be between 5 and 8 million. Okay. So it's still pretty high. So if let's just say it's 5, you would not, your beneficiaries would not, your estate would not pay any taxes, estate taxes, anything below 10 million, right?
Yeah.
5 million.
And we're talking federal, as some states have pretty high. I know the state of Minnesota, I think it's 4 million.
Okay.
For state, where
Illinois,
I'm from.
So Missouri does not have that tax.
See, that's awesome.
Yeah. But Illinois does. And, right here on the border, I mean, we work with a lot of Illinois clients. So, we have to consider
Minnesota does too. Yeah. So what I was going to
get out of that state, Tony. It's really, really cold in the winter, and they have estate taxes.
They have high taxes. Yeah. So what about a hypothetical then? If the Tax and Jobs Act is allowed to expire, if Congress or the new administration allows it to expire untouched, what happens then?
So they just revert back to what they were, right? So rates would return to what they were before the legislation was signed, which was $5.49 million or $6.98 million when adjusted for inflation. So they did put a little inflation factor in there, Tony. And that's why I say most of the people, experts say between 5 and 8 million. So that's where that number falls right in the middle of that.
Sure.
But the point is, who knows what they're going to do. But let's go back and use this example of a $14 million estate. Okay. You would have to pay taxes. Let's go to the high end. Let's say they do adjust it for inflation. And let's say the estate tax exemption is 7 million. Okay. If you are a single person and your estate is 14, that means that they pay estate taxes, your estate or your beneficiaries, on $7 million.
Oof.
And if the tax is 50%, that's $3.5 million, Tony.
Yeah.
I mean, what? It's just, you pay taxes all your life, sales tax. I mean, on and on. Everybody knows what the taxes are. You pay taxes all your life. You save money. You're responsible. And because you were successful and responsible, you got to pay all these taxes. Like it's whatever. Anyway, did you know that the estate tax has gone away several times? Like it's been zero, which means it's come back. Oh yeah, which means it comes back several times, right?
Yeah. And unfortunately, with our the U.S. debt that our government's racked up and our budget deficit and the debt, between those things and their refusal to cut spending, I can't foresee taxes going down.
That would be a Big 10-4, buddy. Yeah. I don't see any of this getting better. I do predict that the estate tax exemption will be somewhere around what they would revert back to. Excuse me. Yeah. I think it's going to be, like most people say, between 5 and 8 million. I do think that even if Trump wins the election in November, that you'll probably see the 2017 Jobs and Tax Cut Act that revert back to those rates.
Interesting.
Again, yeah, I do. That's just my personal thoughts. I don't know. Obviously, no one knows, but that would be something that I would expect.
Yeah.
But who knows?
Government, unless they could cut spending to help, but
That is what they call an old knee
from the
slapper there,
laughter.
Tony.
Yeah,
There
yeah.
there we go. Knee slapper. Yeah, let's reduce spending. Yeah,
Yeah, they
okay.
haven't done
Yeah.
that since in my lifetime. So,
Okay,
over
we could
50
have a
years.
whole nother show on that one. Okay, but
Well,
we're not going to.
yeah. Well,
So
hey,
because
really quick,
yeah,
before we move on here,
yeah.
again, how can our listeners get a hold of you, Brock?
Listen, just give us a call at 573-332-7855. It's that simple. Or you can go to our website. It's alspaugwealthmanagement.com. Click on the website. You can request an appointment with me right there on the front page. It's literally right there at the front. Request a complimentary consultation. Look, here's the deal. All of these things are within our control, even though we don't know exactly what's going to happen in 2 years. Okay.
Right.
But there's some planning to be done when it comes to taxes. And if you're not planning for this, if you're not talking to someone that understands how taxes and inflation impact your financial plan, you need to. So just give us a call at Alspaugh Wealth Management. Again, 573-332-7855. Or that website, again, is alspaugwealthmanagement.com.
Yeah, because you need to have a plan in place and you don't want to go it alone. And if you feel like you have a plan or you've worked with somebody, get a second opinion on where you're at with your finances. Or if you have any questions, I know you're offering that no charge, no obligation consultation. And Brock, you and your staff there are set up to do this. And there are so many aspects and ways to plan ahead and take advantage still of the current low rates we're going to have for the next year, at least, hopefully. So
Right.
hopefully that maintains, and I hope that they reenact it, but it doesn't look likely, right?
You know, I have several business owner clients, Tony. And so when we're talking about these exact things, these taxes, what's another tax? Capital gains rates, right? That is a huge one. The maximum is 20%, 0, 15, and 20. Okay. And so those are the different levels of capital gains taxes. We've enjoyed those as very low. Well, when you sell a business, it's capital gains tax. And that can be a big decision as to when and how you sell your business. Well, let's take advantage of that if you're on the edge of saying, I might sell or might not. And the other part of that is maybe it's the highest multiples you'll ever get. The EBITDAs are, multiples are really high right now. And I'm not saying a business owner should go out and sell their business. I'm just saying, look, consider those two factors. Multiples on EBITDAs are good and capital gains tax rates are low. That's a recipe to say, hey, if you're getting close to being ready to sell your business, it might be time. Okay. Financially, it might be time. Now, you may not be ready emotionally, and that's a big one too, Tony. That's a big one for business owners. Okay. But if you are, give us a call. We work with business owners all the time. 573-332-7855.
All right. Well, this has been a great show, Brock. I mean, we covered a lot today, and we have a lot more to cover. We'll probably do a part 2 on this topic.
Yes,
so
let's do it, Tony.
What to do, and maybe next week we can talk about, account withdrawals and how that makes a difference, and talk more about that tax-free bucket. I know you love to talk about Roths.
I do.
So, yeah.
I do. Yeah.
All right. Well, hey, Brock, great show today. Is there anything else you want to add before we go?
No, Tony. Look, the bottom line is you have to have a plan. And if your plan doesn't factor in all of these things we've talked about today and more, then you're missing the boat. Yeah. Okay. So don't miss the boat. Make sure that you have a plan. And like Tony said earlier, just get a second opinion, right? It doesn't hurt to get a second opinion. Look, when you're going to have surgery, okay, you don't want to just rely on one opinion for that, do you? No, this is just as important. So get a second opinion if you haven't had one.
All right. Well, Brock, great show. Listeners and viewers, thanks for tuning in. That does it for today's episode of the Retirement Playbook with our host, Brock Alspaugh.